I'm Judy Shaw for NYSE Floor Talk. Joining me today is Art Penn. He is CEO at PennantPark. Art, it's wonderful to have you here on the floor today. Thanks for joining me.
Thank you for having me. Really appreciate it.
Thank you. So now, Art, tell me about PennantPark and what you specialize in.
We specialize in middle market credit, which means providing capital, usually debt capital, to companies in the core middle market, which we define as companies with between 10 million and 50 million of annual cash flow, or EBITDA.
So Art, you have extensive experience in the private credit and the middle market. What is the state of middle market lending and what opportunities do you see?
We think we are in a once in a decade opportunity given what's going on in the markets and where risk reward is. It's very important in our business, the private capital business, that you be aware of the vintage. What vintage are you investing in? What are the deals that are getting done? We think 2023 is going to be a great vintage for middle market private credit because risk is lower, debt relative to cash flow is lower, the structures are tighter, there's tighter covenants, there's more time to do proper, thorough due diligence, and the yields and spreads are higher. Both the underlying base rates, either LIBOR or SOFR, as well as the spreads to those base rates are at very, very attractive levels. So the companies we're lending money to today, we're lending out senior debt in many cases at 11 to 12% yields, which is the highest we've seen it in a long, long time, along again with the strong attributes of low leverage, tight structure. So we think this vintage is a really, really attractive vintage.
So Art, talk to me a little bit more about how you're positioned for 2023 and beyond. How is your portfolio positioned if we do see some economic weakness?
Look, we assume there's economic weakness. We're lenders at the end of the day, so we need to understand or try to understand how these companies are going to perform in a recessionary downside case. Usually when we make loans, they have 5 to 7 year maturities, and during that 5 to 7 years, we make assumptions about when a recession might come. In this environment, we're assuming the recession is happening in the first year. That's the prudent way to underwrite credit. We're not saying it definitely will come in the first year, but we have to assume it's going to come in the first year. So we make that assumption. We're setting up the structures to be able to weather a recessionary environment. And importantly, we try to stay in industries that we think are very recession resistant, recession resilient industries like healthcare, government services and defense, business services, software technology, and certain consumer names that we think are very resilient in this time period. So we try to focus on industries and companies where we think we can be, and we hope we can be among the smartest people in the room. We know the right questions to ask. We've been there, done that, have great track records, and then can select credits that we think will perform well in this environment.
All right. Well, Art, wonderful to talk with you. Thanks for joining me on Floor Talk today.
Thank you very much.